here just around 3:30 p.m. Eastern time on Monday the 6th. We are continuing in with this U.S. government shutdown. Started officially October 1st. Now it's the 6th. Nothing resolved over the weekend. Everything on the economic calendar continues to be tentative. So that would include data for Thursday, Friday this week. The big one would be non-farm payroll. Intraday price action for today. We opened up this morning with a small gap up. We came back. We're still, and I keep mentioning this stuff, positive gamma days. Here is the divider. Above this is positive gamma. Below this is negative gamma. Even though the market pulled back a little bit this morning, it's still buying the dip and it's selling those puts and it's melting up into, we started at the 50% ATR. We got back to it. We're sitting kind of right on it for the day. We did not. I was trying to sell these this morning for my daily profit play. I was trying to sell up into the 100 plus percent ATR in case the market was going to be a bit more directional on the day. It wasn't. As far as the opening bell price right in here, I mean, market opened up around 67.33. It's only up 9 points on the day. What's kind of crazy is the plus minus was 27 points. And we're here at the open and right now here at the close, and it's a niner plus or minus 9. So market makers did a fantastic job on Monday, just doing what they do best, which is keep things pretty contained. The one thing that threw me off this morning is we do have a pretty elevated VIX. The VIX is up into 16 plus. So it just means that we could potentially be staring at a 1+% move on the day. It just hasn't happened. In fact, all of these, by the way, all of these days here with this kind of choppy VIX back and forth, anything where the VIX is greater than 16, that potentially means we could go 1% on the day. Now, it rarely does because obviously that's within like the distribution of what's going to happen the most. We're not going to see 1% very often, especially with a VIX at 16, but it is there as kind of the outlier stretch move to the downside or upside. But what we have seen is even more tightness to price. And the one thing that makes me a little bit nervous, is we do have higher lows in the VIX and we have equal highs in the VIX. And if this is any type of technical outlook, this coils, and it might let off some steam where the VIX gets above 17 plus, maybe gets back into 1920 for a little bit of a correction, a little bit of ventilation. But that only, to me, that pullback is somewhere around the 21 period on the daily time frame or the 50 period on the daily time frame. If it pulls back deeper, that is fine. I'm still going to be buying those dips. I will still buy the dips. Okay. But we will see it. Otherwise, I think this market is pretty gung ho on the path to least resistance, the, little to no disruption, set all sights and all, all coordinates towards 7,000 plus. Now, one thing that potentially derails us this week, if you look at this chart, this is in the background, the red and the green shaded zone represents the weekly candles. And then each day I have the opening range breakout. So what this shows me for today is here is Monday. This was last week, Monday and Tuesday and Wednesday and Thursday and Friday. Okay. So last week's high right here. If we don't make a convincing close above the highs this week, and this is a big if because obviously we're right there next to them, but if we don't make a convincing close above the highs, then we might stall at this week's high, or we might stall at last week's highs. If we sweep the low from today, then we could possibly enter into a negative gamma environment and we might come back and retest last week's low. So that's about the only thing I can see this week is the market maybe does not make new highs and we work our way lower. What would have to take place this week? I don't know. If the market believes that there's no jobs numbers this week, and so we'd have non-farm payroll that didn't get pushed out last Friday. It's on the calendar for this week Friday as tentative. If it gets pushed out another week, it just means that the reality is we're probably going to be facing some higher unemployment. I think the true number is we're being told is 4.3. That's what's on the calendar for this week. If you go to Friday, so Friday the 10th, it's like none of this data comes in. So if this is all tentative, doesn't pop in 4.3, it's like when we eventually get non-farm payroll, is it going to be 4.3 still? Is it going to be a lackluster job report? We had paychecks that was announcing, some of the least amount of hirings for a while. I don't know. I don't know. But like if you look third party wise, not just BLS data, if you look third party, it does show that the labor market is stalling. And if we're laying off federal workers to go on top of that, I mean, that doesn't look good. So anyway, I mean, this is why the Fed is cutting. Everyone's wondering, like, the Fed's cutting. They held off because of this persistent inflation. Well, a slight uptick in unemployment has actually had historical correlation with an uptick in unemployment is also a cause for the Fed to be cutting. The difference here is like we're cutting at all-time highs in the markets. And so I think there is a way where this still is a good thing for the overall markets, the overall economy to have easing in the monetary policy. But it is kind of a juice market where the fiscal policy is still very dominant and very strong. We're spending 6, 7, 8% deficit spending while we're getting rate cuts at the same time. So Fed Watch tool, really really high probability baked into to October and to December that we're going to get 2 more cuts coming into 2026. Looks like maybe a cut into Q1, so like a March April cut. Pretty high probabilities. But then after that, once we get to like that 5th cut for the year, this would be number 2. This would be number 3. If we get a 4th cut and a 5th cut, like the market is pretty much looking at like summer of 2026 out to, fall of 2027. It doesn't know if we're going to have more cuts or not. And I don't think we're really going to find out until probably, May or after next year. So what the market has been pricing in with a lot of enthusiasm is high probability cut in October, high probability cut in December. The one thing we have been seeing in the rate side of things, look at the 10-year yields. They have not gone aggressively higher. If you recall what happened back in the Fed cutting cycle here. So the Fed cut rates on, I don't remember exactly what day it was. I want to say it was like the 17th of September. In fact, I can look at my calendar here. So let's go back to September 2024. Must have been the 18th of September. So the Fed cuts on FOMC day, it would have been the 18th of September. And that is literally where this yield bottomed and this thing was ripping up. And that was the rate of change that I did not think was a good thing, right? This is one of the first times in 40 years that the bond yields go up almost the exact amount that the Fed cut rates, right? The Fed cut rates by 100 basis points. This thing goes up 120 basis points. That was not fun. So are we going to see the same type of thing where the Fed's looking at cutting 75 basis points by the end of the year? Is it going to cut, 125 basis points with 5 more cuts kind of baked into 2027? Well, if we cut another 100 to 125 basis points, does this also go up by 100 plus basis points? Because I can tell you that if the 10-year yield is up to 4.8% or 5%, I don't think that there is any way that the stock market can stay at these highs. But if it is going to stay sideways, where it doesn't really go down or up and it just stays the same, I don't know why it would do that. But if it does, that's probably something the market can be accustomed to or the market can survive with. And it doesn't have any type of big, aggressive, nasty rate of change that catches everyone off guard. So I think this still is a big question mark for 2025. Well, I guess we'll find out more as we go into, October, end of October. We should have at some point. The government's going to come back online. Right now, the betting markets are showing somewhere between like 15 and 20 days. Most of the shutdowns don't really yield anything that's negative for the markets. It's usually an average move of like 0.4% positive. I'm pretty sure since the shutdown, we already saw that. In fact, I can note it on this chart here. October 1st, I'll just make a note. Let me go to the starting point of October 1st. So October 1st is here. So here's your big kind of noisy day. Futures was down, then it gapped lower, worked its way back up. So this would be technically government shutdown. I'll just put a arrow here. And October 1st, U.S. government shutdown. Okay. And from that point, we opened at the lows and the market's already up 1.3% since the shutdown. So, if the historical average is the markets are up 0.4%, I don't know if I have the screenshot here inside my charts, but I know I pulled some information. All-time highs, I think we're at 30 plus all-time highs for the year. Do I have? I think I found it on Twitter. I'll find it. I'll come back with it tomorrow. I'm looking at some data here. I thought this is interesting. The debasement trade, This is why some of my best performing assets has been being long the indexes, being long the S&P, the NASDAQ, being long the Russell, being long gold and silver. I did take some silver and gold profits today. I closed down quite a few positions. SLV long, GLD long, CEF long, PHYS long. I'm going to average back into them. The easiest way I can do that is just to set buy levels. I was looking at originally doing some synthetic plays and keeping some exposure here. But if we see a correction, okay, a correction in any way, shape, or form, I just want to add some more. So the 21, the 50, I mean, I'm just going to dollar cost average it. And then once I establish that position, am I getting in with X number of shares? Is it the proper allocation percentage? Otherwise, if I did a synthetic, which means I would sell a put and buy a call, it's going to cost me a reasonable debit, not something obscene, but let me see what I can look at on SLV. The difference here is, we've had an incredible run on SLV, but if we have a period of sideways, a synthetic long does not actually help, right? What is better for me is just to get in dollar cost averaging positions. And then once I'm there, establishing more puts, more ratio spreads, ways to take these trades. But if I went to, could I get something around $30? This is now around $33. Let me see something on SLV. So I like SLV enough that if I went out to, let's see, I have a couple trades out to the end of this year. I know in SLV I still have some trades running. So I've got, let me look SLV first. So it's cheap enough that I wouldn't mind, going out to the end of the year. All right. Let's see here. You going short NQ? Okay, Daniel. That sounds realistic. I mean, obviously, if it turns over, it's like if we fail to break new highs, we sweep today's low. Then yeah, I think the market can have a sideways 1% to 2% correction. Yeah, we'll see. It's like another week. The market's up 1.4%. Average shutdowns up 0.3, 0.4. To me, that's a buffer of 1%. It's like the market's up. We can still finish this shutdown and technically say, yeah, it was up during the shutdown. But basically finish like flat, And the previous shutdowns we had during Trump, it was actually negative. There's just, I don't know, it's just noisy. Different market, obviously, but paying close attention to Fed speakers this week for monetary policy clues. Yeah, well, there's meeting minutes on Wednesday, so the Fed will have data points, and that could be a talking point. So if the markets are getting some volatility on Wednesday because of the Fed, it's like they're just grasping at that data point, right? If there's no non-farm Friday, if there's no unemployment claims Thursday, then the only major headline news is going to be the Fed on Wednesday. All right, let me go to the option chain on SLV. I do have, so I closed out shares. I closed out calls. I'm sitting with puts. This is out to December of this year, June of next year. I'm going to go out to the end of 2020. Let's go to the end of 2026. So I'll go to December. I can go September 2026 or January 2027 on SLV. And I do have some buy levels in. I'm watching some buy levels. I'm going to do a ratio spread here if I can get it. So maybe the 33 by 32. A ratio spread is just not that exciting. It's an income trade. I'd rather just buy the shares. GLD is a little bit different. A ratio spread actually can pay me a couple of dollars. So it's maybe a $200 to $300 income trade, where SLV is like I make $70. I'm going to make more money in SLV by just buying lows. So if we have a pullback in SLV, here's a 50-day pullback at $38. If we pull back to the 200-day, there's $33. I would gladly take, this could be all-time highs. Does silver just blow through this level? I don't know. I hope that it doesn't. Obviously, I want to see some dips and pullbacks. But what I'll probably do is if it's going to all-time highs and it stalls up here, well, I'll probably have to take a dollar cost average position. And if it falls down, I will dollar cost average and try to establish from, this all-time high, okay, back down to some technical resistance becoming support. I probably have to give myself like a $10 to $15 room to potentially add, maybe 3 to 5 different levels on buying some shares of silver. If they collectively add up to a dollar amount that I'm comfortable with, if they collectively add up to a percentage allocation, I think this is something I have to have moving forward in SLV and GLD. Okay, it's a little bit. I mean, if I want to control 100 shares, it's certainly a little bit more cost effective for me to control 100 shares in SLV than it is in GLD. But I still think the trades are about the same as far as like having gold and silver in the portfolio. I like both of them. The reason that I protected profit is my SLV position was up to $94,000 in profit. My GLD combinations between PHYS and I'm trying to think collectively. I know between PHYS and CEF, it was around $17,000. I know that my GLD was up around $35,000 and my silver was up about $93,000. So, I mean, it's 145 grand in just gold and silver. And that 145 grand out of what I've made so far for the year, I mean, 21% of my gains for my portfolio have been because of gold and silver this year. I don't want to lose out on that. I don't want to be silly and think like it just has to keep going higher because clearly, technically, we are pretty overextended. I know that I can miss out on some upside, but just in case this market hiccups at all and has some pullbacks, if the dollar bounces, bonds bounce, pullbacks at 2 to 5% in the stock market, I don't want to be thinking like there's a shakeout with volatility and all of a sudden I'm like reacting to a fall in silver or reacting to a fall in gold when instead it's like, look, it's at the highs, volatility is low. Let me just take the profit. And I contemplated putting in a stop loss and just doing a trailing stop loss. But if it's let's say it's a limit stop. Well, limit stop, if it gaps lower and my limit stop is right here and it doesn't come back to it, then I'm just going to give it back anyway. So I mean, I don't want to take the trade where I get filled at the only available liquidity price and it could be below my level. So anyway, just be safe. I'm doing the protection on that, trying to collect some good levels. Floyd says silver go. I know it could. But look, man, I mean, is silver going to go to 75 or 80 without pulling back? Like, I hope that we at least acknowledge the technicals here, right? I mean, if we're talking 75 to 80 silver, that like this chart is broken, you know? I mean, so what I'd like is, okay, we have some more upside. We have some pullbacks here. I mean, just give us something in here to buy the dip. If it's going to go higher and higher, like fine. Silver comes into levels it's never been before. That's exciting. But to just go straight parabolic, I promise you one thing. If we go to $80 on silver, it is not going to keep going straight up. It's going to come all the way back down and it's going to be a terribly volatile trade. So the better trade is if we stall or we pull back, I'm going to keep positioning for more. But I'm going to protect the 6 figures of profit that I had in my hands to make sure that I've got that kind of banked in for the year, and then I can reestablish new positions. I can always start somewhere. If I was worried about this, it's like, okay, so I can buy shares, sell a put, or I'm sorry, buy a put, sell a call. But the problem with SLV is the premiums are so bad that selling a call doesn't really make it worth my time. It's like, do I do this trade and get like $1? If I buy shares, let me just do this right now. If I go out to January 2027, or I go out to, I'll go out longer. I'll go to like Jan 2028. If I buy shares right now at 44.12 and I go up to I guess the expected move, it's like this goes up to $60. I sell the 60 and I can buy a put. This is what's kind of crazy is I can buy a put around $40. So one thing I could do on SLV is buy another chunk of shares at 44.14, lower my cost basis by 57 cents and have a put at 40 that allows me to lower my cost basis with any type of decline in the next, 3 to 6 months. So that's not a terrible trade. I might just kind of mull this over for tonight and think about taking this tomorrow. So if I buy 100 shares at 44.13, okay, and then I put in a collar trade where I sell the 60 and I buy the 40, at least I have some downside protection. And my put is way closer to my call, right? It's way closer to my actual buy price than it would be if I'm selling the call out of the money. So I can kind of finance. If I went 57, 58, it's like, I'll just go up to 60. If I get it called away, my break even would be I buy 100 shares at 44.13 minus the credit of 55 cents, get it called away at $60. I make 16.42 a share. If I've got another, 2,000 shares of silver, there's another $32,000 on letting this thing rip higher. Okay. And in addition to that, I can still dollar cost average in, trading zero options on that stuff, but just dollar cost average in with the numbers that I want. But knowing that my break even is, just below current price, I've got downside protection. So if we do drop, let's say we drop to 30, $33 or so. Well, I can take this 40 put and probably add, if it drops, let's say, I guess it'd be $10, $10 at a 33 delta. I can turn a 525 debit into like $8, $9 credit, lower my cost basis more. So anyway, there's a couple ways to do it. It's not perfect, right? If I'm going to buy something, $4 here, protect it $4 lower. It really depends on how ugly the downside is, but I would feel silly to not have protection. Period. And if I want immediate protection, then I take the 60 call and I go tighter to price. And now I'm willing to pay $1.71 and I increase my cost basis, but now I still make, I guess $15 per share and I have immediate protection. So if it drops down $14, then I go 14 times a 41 delta, 574 plus a 795. Close it down for a $6, $7, $8 credit, make 100% on my put, lower my cost basis by $8, and I go from $45 break even to $38 break even. I don't know. It's again, there's a lot to think about, like how much I want to get invested right away. It's like I just close out for about $150,000 in profit. I'm just going to make sure, like, whenever I'm stepping back in the market, let me make sure that I'm happy with my decision. I either buy shares with a collar, or I establish some type of synthetic position, or I just have to have the patience, right? I mean, what would bother me is if I don't get a pullback, and this thing does break some highs and blisters up here into the 50s. Well, obviously having the 2,000 shares that I had, it's like I'm forfeiting some of that profit. So I think scaling back a little bit would be good. I trim it down to, instead of having 3,000 shares, I trim back to like 500 shares, trim back to, maybe 1,000 shares. And then if we dip, I'm trying to ride some of that protection to the downside. And then I think silver finds some support. We work our way through it. I'd love to see the floor at silver stay above this moving average, which right now is around 30, like $32. But if we come down to, price levels, like $28 is major support right now. And I hope we find it. So just to get a little context here, let's go into the weekly chart. The last time we hit these all-time highs, we did have a pullback. Okay. And it wasn't pretty, right? I mean, we went from here all the way down. Now, this was silver, the industrial metal, not a strategic metal, but silver declined 73%. Am I prepared for that type of move? Well, obviously, if there is a high, low, lower, high, lower, low, I'm prepared for that move. But if we go lower, high, lower, low, this is all just one big waiting game. Wait for this thing to trough. It troughs out, and then we see the bullish pattern. I think the crazy part about silver would be if we break these highs, it is in a whole new atmosphere of there's no resistance. So if we break these levels, I mean, I don't know if we just double, right? I mean, going from $9 to $48, if we take this move right here, is it possible? And I'll throw this on the chart. I'm just curious, just like anyone else. Is it possible that we take this low to high, okay, and then double that move? Because if we do that, who wouldn't love to see this thing back up into, $87? I mean, I certainly would. So can it get to 85 or $87? I mean, that's just a measured move. So, I mean, sky's the limit for break resistance. So buying the dips and following this trend. But here's what I will say. Is it likely that it goes in a straight line like this, or is it likely that this market does something like this, where we have pullbacks and pullbacks and pullbacks and pullbacks and pullbacks? I mean, you'd like to think it behaves that way in some way, shape, or form. That makes sense? So if we go up and we get stretched away, we stall out, put in a topping pattern, maybe work our way back to the EMAs, then I'll start buying some more. And then from there, target the highs. Pullbacks, target the highs. Pullbacks, target the highs. And continue to see if that's how it behaves. That might be wishful, efficient thinking, but it's certainly better than buying it here without protection and you get some upside potential, but you're dealing with maybe a 20+% pullback. That's my only concern about getting right back in. Is if we have a decent pullback, this pullback could be, I mean, easily 20+%. On the daily time frame, same thing. We pull back to these EMAs. There's a 200-day moving average that I would be watching. If we pull back to that, that is a 25% correction. So I'm just throwing it out there. Gold, all of a 15+% correction at some point in time. Silver, 20 to 25% correction at some point in time. I just don't want to be left with all these profits and watch, a third of it get given back. A half. I mean, if I give back half the profits, I'd be pissed. So I'm protecting the profit and I'll reestablish new positions. Okay. So the easiest way is dollar cost average in. That's the easiest way. But if I want to maintain some silver exposure, I can buy a put, sell a call, give myself some upside potential, let it get called away. That's okay too. It's just going to add to what I just took in, right? So that way it doesn't cost me an arm and a leg, and I can lower my cost basis with it as well. All right. Anyway, I think I beat that up enough. Let's go heat map today. We got just a few more minutes for the close. Prices are hanging out. So open today around 33. We're trading up to 44. We've only had about a 10 to 11 point on the day. We're not quite at all-time highs. We're going to see what futures does overnight. The positive, negative gamma, just keep watching this stuff through the week with me. I watch this stuff every single day. Right now on the SPX. SPX positive, negative gamma is around 67.15 today. I'm waiting for this to update. There we go. So we're hanging out around 67.40 and 45. Right now, positive gamma is above 67.15. If we stay above 67.15, this market just kind of keeps grinding higher. Last week's highs were just on Friday. We saw last week's highs on Friday. So that's what I'm saying. Watch the highs from here. If the market wants to breach them tomorrow and we take out this high, the probability of hitting this low is only about 40%. So that would favor the edge being, even if the market rolled over, it's probably not going to sweep these lows. So I wouldn't really turn bearish on the week unless we, number one, did not take out the high, and number two, if we take out today's low. If we come into trading tomorrow and this thing sells off, then we take out the low. We're probably gunning for this low, and I would be a little bit more bearish if we pivot to negative gamma. So tomorrow morning on my daily profit plan room, let's look at our daily profit play grid. Let's see where we're at. Okay, today's price action, we're just kind of hanging out above the 50-day, but we're less than 100. I still didn't get filled on a single trade today. I posted my trades at the just over the 100% ATR. Didn't get filled on the trades that I wanted. I tried to do an iron condor. I tried to do bear call spreads. I didn't get filled with the credit that I wanted. The only trade I had this morning that lined up would have been like an 85-cent credit on a 5-wide spread. I just thought it's just not a good trade. Not a good trade. So I passed. So unfortunately, I didn't get a daily profit play today. Waterfall income, we took a nice trade. We're staring at a trade that we did roll out to the 10th. I'd like to see if prices can get back down to 66.40 if possible. 66.40 would be a pretty miraculous gift from the markets. That would only require a 1+% drop. So it is possible. 66.40. I mean, that's a 1.5% drop. FOMC meeting minutes on Wednesday. Maybe it moves the market. Maybe it doesn't. I'm really going to kind of assess that as we come into the trading day Wednesday afternoon. Because if we are sitting here with positive gamma, we'd have to get to negative gamma and then maybe opens up the floodgates with the VIX up to 16 plus. But we're just sideways on the VIX. We're sideways in price action. Just kind of taking it one day at a time. Okay. If oil follows gold 20 months, this month will mark gold's low. If oil follows gold 20 months, this month will mark gold's low. What? So you're saying, are you looking out 20 months in the future? Because you can't have gold's low 20 months ago because we're sitting all-time highs. EMA is still, it's the 21. So I've got a 20. This is on just kind of my general chart. So 21, 50, 100, 144, 200, all exponential moving averages. Okay. Speaking of oil, so oil, I think oil is still this is one reason that inflation has been pretty tame in 2025. I think that the US economy is fortunate that oil prices have been very, very contained because the one thing inflation-wise we haven't had to worry about is higher energy prices. I do think this is changing in due time with the rising demand in oil, rising demand in natural gas, rising demand in everything energy. UNG. I am holding some calls on UNG. It was a diagonal spread that I can keep kind of selling against, but I'm looking to see if maybe I get a trade running on UNG. So I have a $5 call. My break even is around. I think my debit's around like $12 right now. Um, so I mean, I could sell some calls at 15. I probably should. This is out to January 2027. What I was looking for is if natural gas can just make another run to the upside, is rather than selling a call and just letting it get called away, is trying to get a run up here where we get like another squeeze on natural gas and it goes up towards 22 to $23, and I can turn it from, instead of like a $3 to $4 profit, I turn it into like a $10+ profit. Now, I don't know if that's going to be the case. Natural gas has been called the widowmaker for the last couple of years, so we'll see. But anyway, I'm going to see what happens. I don't think we go too much lower on natural gas, but chart alarm set here. Let me set another one at 20. I don't mind getting out of this thing at $20. Whether I sell another call against the current diagonal that I'm in, or just get out of the trade. Because the one thing I do have is time. This goes all the way out to 2027. That's why right now, if I'm looking at longer term, like SLV, longer term gold or GLD, I'm looking out to like January 2028. I want to go out as far as I can. One thing I'm also watching here, FXY, JPY is getting a little bit weaker. Currency strength. We saw a big move in the Japanese yen over the weekend. Like ridiculous. In fact, I saw this last night. Like, what the heck, Japanese yen? So this is why I said, like, you just can't trust the yen. I mean, this is so unusual in currencies to see the market gap like this. This is insane. Yen seen is unlikely to weaken much further. I mean, I don't understand this move. Like in currencies, this is so rare to have a gap like this. Look at all your gaps. Aussie yen, huge gap to the upside. I'm telling you, in currencies, I know this is scary stuff. Okay, like you don't see a lot of gaps over the weekends in currencies. This gap will likely fill. The hard part is how do you trade it, right? Like in FX, when it's a leveraged market, it's like, do I fade this move and hope that it comes back down? I mean, who knows, man? This thing could go up another 1, 2, 300 pips before it falls back. The only trade I would consider maybe fading would be Swiss yen. If we come back and take out this low, I might be willing to put in some sell stops and see if this thing actually rolls over. But if this keeps going higher, I'll make a bold prediction. By the end of this month, I think that we probably hit this gap. So I don't know if I'm going to trade it because it's just you're always playing with fire with the Japanese yen. But that's such a crazy gap that I mean, if you look at like a weekly R1, R2, R3, and maybe consider taking a sell trade there, maybe. But I don't see any like crazy monetary policy stuff. Conundrum. It's actually positive swap to be short this thing right now. But let's see what happens here. BOJ according to FX options. Let's see. Premium break-evens can offer clues about perceived extent. Volatility is an unknown part of the FX premium. That's old school. January 23rd. I mean, that's old. That's not. I want news. None of this stuff has news. Look at dollar yen. There's got to be some other explanation on why the heck this thing gapped. That's such a ridiculous move. This thing gapped up 300 points. That doesn't happen very often ever in currencies. So more events. Japanese yen, euro slide, fiscal concerns. Let's see what it says. So do we have a new female prime minister? Looks like is lining up in Japan. Policies may delay BOJ's rate hike plans. Well, there you go. So instead of raising another 25, 50 basis points, if they delay that, there's a weaker Japanese yen. So highest since introduction in 1999. Yikes. Swiss franc yen is at all-time highs. Fiscal political stability concerns after Japan's ruling Liberal Democratic Party elected a new leader. France's new government quit. Boost the economy with aggressive spending, easy monetary policy. So we've got Abenomics coming back into the BOJ. Wow. So it's just a big reduction in rate cuts, or I'm sorry, rate hikes. Markets were anticipating that the BOJ would be raising. Oh boy. Let me zoom in here. I think this is a good one to just keep an eye on. I'm going to save a couple screenshots here. So it was unexpected for that PM vote. There's a little bit more focus on the back end of the curve now, just given that Takachi or Takaichi is generally seen as follower of Abenomics. That's super weak then. I mean, that's super dovish for the Japanese yen right now. Doesn't mean I want to be long. I really don't. I think that it's just a weird currency play. I would just tread very carefully on the Japanese yen. Traders are waiting for signs the U.S. federal government will reopen, which hasn't happened yet. Congress so far unable to pass a bill to continue funding operations. Shutdown is leaving avoiding U.S. economic data, which we know, jobs report, unemployment claims. I think it's all eyes on the Fed then on Wednesday for the minutes. Market volatility has dropped significantly since the start of the U.S. government shutdown. Risk to U.S. economic activity. Okay, Fed cuts expected by the end of the month. High probability is like 90+% baked in for October, another 83% for December. Okay, well, yeah, that's a crazy currency move for sure. Just saying, don't be terribly surprised if either, I mean, in the land of Japanese yen, either this is the sign of bull flag and things keep going higher with a crazy weak pricing in of a dovish yen policy, or none of it matters. It's all noise, and there's resistance, there's support. We hit resistance, we come right back down. So honestly, I'm not going to touch this thing until the end of the week, and I'll just say, yeah, interesting. It came right back down to fill the gap. So if you are looking at this on a shorter time frame, okay, let's look at the Japanese yen on a 15-minute. Is it possible that on a 15-minute time frame or a 5-minute that this thing rolls over into a sell zone? Okay, like right now on the 5-minute chart, is it possible that it rolls over into a sell zone? You take a sell trade here, you stop above, and if this thing goes to test this low or fill this gap, then you're going to have a sell zone, and you've got reward to risk. I mean, you could probably line it up on a small enough time frame, but I want to see price at least take out this low and get into a confirmed sell zone. And if you do that, sell one, maybe sell at the high, so 1 and 2, stop loss above, and then see if this thing actually rolls over into a gap fill. But it is a trade that should have defined risk. Do not let this thing like scale in thinking it's a sure thing. I've been burned in the past many times, so don't get overly excited about these big gaps. They should fill, but that's also a big surprise to the FX market. I think everyone thought that the BOJ would be raising rates, and so the curve of raising rates versus cutting rates, the BOJ went from negative to neutral to now positive. They're up to 0.50, and the markets were anticipating that the BOJ is going to raise up to like 1%. Well, it looks like that just disappeared. So if they stay the same, then that means we still have this like positive swap for like everything against the yen except for the Swiss. The Swiss is at 0%. Every other currency has a higher yield against the yen. Okay. So keep an eye on it. We'll talk about this more throughout the week. Okay. All right. Tail of the tape for today. Markets were green. They didn't really move a lot as far as the opening bell. We gapped higher and closed pretty much at the same price. So here was my gap open today. We finished right around the 50% ATR is at 67.38. I'm going to take a screenshot of my daily profit play. So daily profit play. It was not in between. It was not in between the 50s. But I'll take a screenshot here for my tracker. So copy link. And today, post, close at 67.40. Overall, very quiet, open to close price action. So we opened around 33, closed at 40. So 7 points. So plus 7 points from open to close. The 50% ATR was at 30. I've got 38 here, about 38. The 50% ATR was 67.36 to 67.38. And price closed just above. And no filled trades. Trying to sell high, sell premium, out of the money. All right, so I'll wrap that up real quick. So we have between is a no, and win the day, no trade. So we didn't get filled today. But that's fine. We'll come back and tackle it again tomorrow. DXY was up a little bit today. Yes, I saw that. Up a little bit. Let's go down to the daily. So DXY up a little bit. Okay, I think the dollar still catches a bit of a bid. If the way I see the dollar playing out in this like little window of weakness, if we see the stock market hiccup at all, if this prolonged government shutdown is going to scare the market into a bit of a sideways move or correction, this might be a play, something like this, and maybe something like this, right? So this big swing down, making lower highs and lower lows, lower highs and lower lows. I mean, everyone would be like, "Oh, the dollar's bearish." I'm telling you, this trade would be a squeeze to the upside. Before I really want to get bearish on the dollar, it's a squeeze to the upside first. Then I will get bearish the dollar. So I'm not selling the dollar. I'm not buying the dollar. I think the best time to buy the dollar would have been right there during FOMC for some short-term gains. But I will potentially, let me throw this on the chart here. That's not a bad visual. If I look at that as a potential falling wedge, something like that. Okay, and I understand that kind of ignores this previous low, but if this is right where the market is going to make a squeeze to the upside, it's here with some fading patterns that I'd look to sell this back down. Until then, it's in this garbage channel where we might make slightly lower lows on the dollar. If this happens, by the way, this is higher S&P. Okay, I'll just put this here. If we continue to make these slightly lower highs and lower lows, this is the melt up. So if that's the case, I'll put this in black. This would be your S&P melt up. We'll continue. Okay. If we end up breaking above DXY strength, then I think this is your S&P pullback. That makes sense? So if the market sees that on the dollar, I think that dollar strength ends up playing around with the correlation of gold, the stock market, Bitcoin. We might have dollar strength that forces that little needed pullback. Okay. So I'll save that screenshot. I'll drop that as a reference later this week. All right. COLB, Columbia Banking. Maybe. I'm more interested in, if I could sell puts at 18. I mean, financials are such low, they're just low alpha. They're decent for buy and hold. We might have some decent performance on them. Fundamentally, I'm sure it's pretty strong. Let's go to Simply Wall Street. I mean, a lot of the regional banks, they just look so good, snowflake analysis wise. 15 times earnings. I mean, that's good upside. It's just, is it going to happen super fast? I don't know. Probably not. But if I buy some here and price goes up, great. You get some appreciation, and you should have a dividend here too. It's probably not awesome, but you should have a dividend. I mean, 5.45 is not terrible. If I bought some here, area 1, bought some here, area 2, the risk is insolvency. That's like the big thing with these regional banks like we saw in 2023, but it was backstopped pretty quickly. There's a lot of support around the $19 handle. I'll put this one on the map, Daniel. COLB. But if I can look at COLB, there's a lot of those regional banks that you probably take a look at. KRE. This one looks a lot different, and it's more expensive. So, I mean, HBAN, another regional bank. It's cheap, making higher highs and higher lows. Not a bad one. Snowflake analysis wise, looks great. So I wish there was a cheaper sector than just KRE. So let me see if there's a regional bank ETF. So there's KRE, there's leverage, which I don't want to do. Here is KBWR. That's a little bit pricier. KRXTR. So I'll look at a couple of these. So COLB, HBAN, KRX. I don't want NASDAQ. I don't want I don't know if that's tech banks. We'll go here for KBWR. And we'll go IAT. Take a look at those. Futures on regional banks. I mean, if you want some exposure and you want some gains, that could be some leverage right there. XSB for futures. Anyway, I'll do some diving over the night. So, all right, I'll let you go for today. We'll come back, do it again tomorrow. Tomorrow morning, daily profit plan in the morning, technical Tuesday. No major news until Wednesday with FOMC. So tomorrow, pretty quiet day. Price action wise, there's a lot of Fed speakers lining up. A lot of it's pointing towards the Wednesday minutes. So maybe that's what drives the market. Otherwise, it's going to be an absent of news. I'm just saying from the day-to-day price action, watch to see, are we at the high or are we taking out today's low? Okay, if we take out today's low, we possibly get into negative gamma. If we take out the high, that means more melt up, less chance we take out last week's low, and the melt up craze continues. Okay. I can't see this being good. If we go all the way to this week and bump out non-farm for 2 weeks in a row and we deal with inflation the following week, I don't know how that's good, that we can just kick out, 2-3 weeks shutdown, have some major data points that nobody's getting numbers on. And I guess from the inflation side, here's a good way to measure third-party inflation. Trueflation shows 2.2, which I think is the same. Yeah, so we've been sideways now for, 4 or 5 months. They're cutting rates. So inflation isn't necessarily going higher, right? Inflation is sideways. So whenever we do get a CPI print, is it 2.7 headline, 2.8 headline, 2.9 headline? I don't think it really matters that much. It'd be like the rate of change. If the rate of change is aggressive, then that's a problem. But if it's like 1/10 higher, 1/10 higher, I don't think the market really cares that much. JP pre-recorded speech on Thursday. Sure. I think FOMC minutes matter more on Wednesday. I think Fed speakers tomorrow, maybe there's something of substance there, but FOMC minutes on Wednesday, maybe kind of the pivot point for the week. So, all right, we'll assess it tomorrow. I'll see you then. Tomorrow morning, 9 a.m. Eastern Time, daily profit line room. All are welcome to join. If you're in my Telegram, we'll post a link in the morning. Okay. Telegram, if you are wanting to jump into a session with me in the mornings, I do this thing every single day, 9 a.m. Eastern Time weekdays. Gamma Report, this is a new segment that I'm running with Kane Shea. We're now live on Mondays at 2 p.m. Eastern Time. Nice to collaborate with him and talk shop every single week. So we had a good session today. We went for like an hour and 15, hour and 20 minutes. But we'll do this every Monday. Stagflation, I mean, not when you can outgrow it. If you're looking at stagflation, but you can see, gold is doing this, S&P is doing this. There's no stagflation when the markets are ripping at all-time highs. I mean, and there's just not. Like, there's stagflation if you are losing your job with a lack of purchasing power with stubborn inflation. Yes, there's stagflation if you're not making money elsewhere. But if you are invested in any way, shape, or form, you should be outpacing inflation. The problem is we're outpacing inflation on things that are still watching a weakening dollar and loss of purchasing power, and we are doing a major disservice to the dollar by debasing the living crap out of it. So it's just one of those kind of realities where right now the market is realizing, holy crap, we need to have gold, silver, Bitcoin, S&P, NASDAQ, anything invested. Have an asset, ride the assets, because that's the only way you're going to keep pace or outperform. If you just sat in cash, you're going to get left behind. And that's not a fun reality for a lot of people. Even parking, safe haven bonds, I think is a huge risk. I really do. So I'm not interested in that. I think that you've got to play the game. Even understanding, I want to take a position in gold, but understand that we should be protecting the downside because gold and silver both probably have 15 to 20% corrections. Okay. The S&P at some point probably has a 5, 10, 15, 20% correction. It's not going to be the last time we've also seen a 30, 40, 50% correction. Just saying. This stuff will happen. It will happen in my lifetime. So if I'm going to be trading for the next 20 or 30 years, we're probably going to see a 50+% correction. And it can be written up in the history books as, oh my gosh, it's the worst since the great financial crisis. Yeah, duh. But problem is, how exposed were you? The good thing is how much can you buy at those discounts? Right? So just saying, we got to get ready for anything. All right. Yeah, I mean, they're up. But I think the T-bill and chill thing is, I don't know. I don't love it. I mean, I think at depressed levels, sure, maybe. I just think that it doesn't look good for bonds. I mean, if I held bonds and I hold them to maturity, then yes, I can get my yield. Yippee skippy, right? But here's what is not fun. If I own the asset, this is different. If I go in and I just do a bond trade. So if you go to like Schwab.com, for example, Schwab.com, I log into my web portal and I actually do a bond trade. This is different than owning TLT, by the way. Okay. Because let's say that TLT breaks support and drops 10%. Well, my price appreciation is down. I don't give a crap if I get a 3% yield on that thing. I'm losing money. So if you want to trade bonds for safety, go into trading, go into bonds, and pick your bond. Because right now you can go out to, and this is not as good as it once was, but look at this. You can go out 5 years and 10 years and get a 4+% yield. Okay. But my question to you is, do you think inflation is going to be sub 3%? If inflation is 3% and you're getting a 4% yield on cash, I mean, awesome. I'm not losing money, I guess, but you probably are, because losing purchasing power, there's no way that inflation is truly going to be matched by just parking money in cash. There's not. Like 4% is not enough. It's not enough. So, I mean, if you're just trying to like melt the ice cube, if you got enough wealth to retire and try to melt the ice cube and not lose a lot, then you can park here and get your 5% or 4%. And that's tempting, but I just think having some downside protection gives you a much better yield. I think the markets, we might have some lackluster returns, but I think between equities, gold, silver, Bitcoin, get some corrections out of the way, get another 10, 15, 20% correction at some, whatever it looks like. Buy the freaking dips, I mean, would we be shocked in the next 5 or 10 years the S&P's at 10,000? Probably not. But how do we get there? Probably not in a straight line. We're at 6,700 right now, 6,740. Do we go to 7,000? Do we drop back down to 6,000? Do we bottom out there, then work our way back to 7,000, back up to 75? Do we drop back down? I mean, 10,000 is not that hard to think about, but it's not going to be straight. I just don't think it's going to be straight. So there's volatility ahead. I'm legitimately nervous through midterms next year. I think that's where most of the volatility will persist. If you have a population that is willing to step up and vote for the first time and swing the pendulum the other way, this might be the one time that 18 to 30-year-olds actually vote a ton, and it might be enough to sway the election. I don't love the idea of swinging from right to left, but if we do, well, there's our two-party political system woken the United States with the circus. But that's not until next fall. So it right now is like the haves and the have-nots is a K-shaped economy. And I think that if we have the technology to understand, look, if you invest in this, if you got left behind, there's a chance to correct it. Invest, right? This goes up, they're invested already. If you start investing, you can play the catch-up game. That's better than sitting, hoping for a job that's going to be gone in 5 years, 10 years, and watching purchasing power go down. None of that looks good, right? This is a super depressing future. But playing the game of this financial market that is rigged to go up, exploit it, trade it, benefit from the inherent bias, buy the dip. Retail's been smart. The stupid thing about retail is how greedy retail gets, right? Because here's what's going to happen. The 5% dip that retail buys, if it goes down by 15, they get smoked, right? It goes down by 20, they get smoked. In fact, you start to hear nothing good, right? Everyone lost. Oh my gosh, my over leveraged account is now down, 50% when the market's only down 20%. But they also typically come back faster. But you got to have the dry powder to get in. It's that third leg that catches off guard. It's like this dip in highs is what everyone's accustomed to. So the dip correction is what nobody likes. Nobody wants to see a third leg lower, right? And a third leg that becomes a fifth leg, nobody wants to see that. But if I'm invested, and we go back up, stay the course. Dollar cost average. Anyway, all right. I'll see you tomorrow. Let's talk more.